Okay, so got this handout I've posted for you to take a look at. So it asks us to do three things. The first is the computation of a payback period, which we'll do. And if you haven't already, you may want to pause the video and see if you can work through that on your own. And then the ARR, which we've had a lecture on in abstract, but we'll work through that. And then net present value, which I'll probably do. We'll continue on, but I'll probably put in a separate video. Alright, so let's start with payback period. Alright, but let's look at what the problem gives us actually. Getting that bit ahead of myself. Leicester Company wants to buy a new machine that will be able to perform many of the steps in the manufacturing process that they currently have to do manually. The hope is that it will reduce the amount of time it takes to create one unit and reduce the number of defective units. The machine requires an investment of $750,000. The machine will last 6 years with no expected salvage value. The expected after-tax cash flows from the project are as follows. All right. And we see 6 years worth of data there, even revenues and even expenses. So this makes the computation of the payback period relatively straightforward. All right, you remember that formula? It's original investment by annual cash flow. And since they're even, we can just divide one by the other. All right. But we need to look at net cash flow, right? This one gives you revenues and expenses. We need net cash flow. So in other words, our formula is going to be the investment, $750,000 divided by the revenue less the expenses. All right. Alright, we get 2.38. So payback period in years, 2.38 years. Alright, so that's all we have there. That is part A. Alright. Part B is ARR, accounting rate of return. All right. Okay, so our accounting rate of return is equal to average annual income divided by the investment. All right. So we need to actually compute average annual income. All right. We have we have cash revenues and cash expenses. We can get the difference between those two. But there is a non-cash expense that we also need to account for. And that's depreciation, right? It gives you the machine will last 6 years with no expected salvage value. So you may remember from 2081, that's really all you need to compute annual depreciation. And so let's actually do that. Annual depreciation is equal to cost of the asset, our cost of the machine. All right, it's a 6-year asset. All right, so annual depreciation is going to be $125,000, and that is part of average annual income, even though it is technically a non-cash expense. All right. So our ARR is equal to cash revenue less cash expense minus the depreciation, which is also an expense that we would subtract to get to income divided by the investment. So we'll compute this. All right. And what we get, we want to think of as a percentage. All right. And so your accounting rate of return is 25.33%, which is a good rate of return. All right. Okay. So we've done payback period, which should have been a review. And then we've also done accounting rate of return. So we'll stop here and we'll come back and I'll do net present value in the next video. Same handout. We'll pick up in the next video.